Hey everyone, welcome back to Corporate Decoder. Today WHR filed an 8K detailing restructuring costs, and I am seeing a significant shift in their operational strategy. Quick note, this is not financial advice, just my take on public filings for educational purposes. Whirlpool is closing a plant in Mexico and consolidating production, which comes with a hefty price tag but aims to boost efficiency. Alright, let's dive into what Whirlpool Corporation has reported. This is a current report, essentially an update on significant events happening for the company. The main news here is about the company's plans to change its factory setup. Whirlpool is shutting down a manufacturing facility in Apodaca, Mexico. This is called the Supsa Facility, and the closure is expected to happen by the second quarter of 2027. They're going to slowly wind down operations there, moving production to another plant in Ramos Arizpe, Mexico, and also spreading it across their other manufacturing and supply chain locations. The goal behind this move is to make their operations more streamlined and to improve the cost structure for their refrigeration products. This kind of restructuring doesn't come cheap. Whirlpool is estimating that these actions will cost them a total of about $165 million. Breaking that down, they anticipate around $95 million in what they call asset impairment costs. This basically means the value of the assets at the closing factory, like machinery and buildings, is being written down because they won't be used anymore or will be sold off for less than their book value. Then there are employee-related costs estimated at about $30 million, which would include things like severance packages. And finally, there are roughly $40 million in other associated costs, which can cover things like contract terminations, relocation expenses, and cleanup. Now, not all of these costs are going to hit their bank account immediately as cash leaving the company. They estimate about $70 million of that $165 million total will be actual cash that they will spend in the future. The rest, around $95 million, is a non-cash expense related to the asset write-downs. They expect these changes to be mostly finished in 2027. For the current year, 2026, they anticipate about $100 million of the total restructuring costs will be recognized, and out of that $70 million in estimated future cash spending, about $15 million is expected to happen in 2026. As with any significant business move, especially those involving future costs and timelines, Whirlpool includes a cautionary statement. They are letting investors know that any statements about their expected costs, cash expenditures, and when these actions will be completed are considered forward-looking statements. This means they are based on current expectations, and many things could happen to change these projections. Risks like delays in completing these actions or costs being higher or lower than expected are real possibilities. This is a standard legal disclaimer, but it is important for investors to understand that future performance isn't guaranteed. Looking at the broader context, Whirlpool is a major appliance manufacturer. This move to consolidate its manufacturing footprint suggests a drive to become more efficient and competitive, especially in a product category like refrigeration that might be facing pricing pressures. This is a strategic decision aimed at improving profitability and perhaps aligning their production with current market demand. It is akin to how many companies reevaluate their physical presence to cut overhead and boost output when facing economic shifts or increased competition. Think about how companies like General Electric have streamlined operations over the years through plant closures and consolidations to stay competitive. Whirlpool is doing something similar here. For those tracking Whirlpool stock, their common stock trades on the New York Stock Exchange under the ticker symbol, while they also have depository shares, which represent a portion of their mandatory convertible preferred stock, trading under WHR-PA on the New York Stock Exchange. The report is signed by Roxanne L. Warner, who holds the title of Executive Vice President and Chief Financial Officer. This confirms the authenticity of the filing and indicates that the financial aspects of this restructuring have been reviewed and approved at the highest financial level of the company. Now, looking at these numbers on a larger scale, this $165 million restructuring charge is a significant one-time expense. While it is booked for exit and disposal activities, its impact on earnings in the short term, especially in 2026, will be notable. The fact that over half of this cost is related to asset impairment suggests they are taking a clear-eyed view of the value of the assets at the closing facility. The cash component, $70 million, is also substantial, but spread over time it is hopefully manageable for a company of Whirlpool's size. The goal here is clearly to reduce long-term operating costs and improve margins. We've seen similar moves from other manufacturers looking to optimize their global supply chains. The key will be how effectively they can transfer production and maintain quality and efficiency in their other plants. So, what is the takeaway here? Whirlpool is making a bold move to streamline its operations by closing a plant. It is going to cost them a pretty penny up front, but the long-term vision is to become a more efficient and cost-effective company, particularly in their refrigeration business. The challenge will be executing this transition smoothly without major disruptions to production or quality. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, smash that like button and subscribe for more. Join our Discord in the description.